Good afternoon, everyone, and welcome to the Monday Open presented by Vantage Markets Australia. This is me, Jeff, in Sydney, and I'm joined by Ollie from the private client group, also in Sydney. We're in separate offices because our tech people can't get our microphones to work at the same space. Hey, Ollie, how you doing, buddy?
Yeah, going right, Jeff. How you doing?
Yeah, pretty good. So you guys are all pretty comfortable with the structure of this, the way that we do it now. We've been doing it for a few weeks. We'll run through what happened last week. We'll talk a little bit about what we're seeing this week in terms of what might be market moving, do a little bit of technical analysis, and then just do a little bit of Q&A at the end. So last week, Ollie, did you want to run through that for me, mate?
Yeah, of course, we'll do. All right, so first big announcement I guess we'll touch on from last week was New Zealand lowering the cash rate. So initially it did see an improvement on the New Zealand dollar against the US dollar, which went against expectation. Although, Jeff, we've spoken about this in the office, is mostly a result of the dollar weakness as opposed to a strengthening New Zealand dollar. The New Zealand dollar against the US dollar was up 5.3% from the announcement to the close of the week. Although the New Zealand dollar did close weaker against the Aussie, down approximately 1% from the announcement to the weekly close. Next up on that week, so the US raised China tariffs to 125%. That'd be on top of the already existing tariffs. But now Trump's tariffs have gone pretty much 125% against China. Simultaneously, he decided to pause the tariffs globally while sticking to his guns against China, essentially just introducing a lower 10% tariff rate across the board. It did set up what I like to call a relief rally in the US stock index markets. The NASDAQ in particular was up 12.16%, which was its best performing day since January 2001. Essentially, it set up an initial reversal of the price trends, which we'd seen since the initial announcement. USD, JPY, perfect example of that, going up 300 pips on the day, and the Aussie US rising 150 pips. Last one in the week, we had the US CPI coming in softer than expected. With tariff fears, kept the dollar weaker against the major currencies. Typically, when we do see softer than expected CPI data, it acts as an indication for future rate cuts, putting further downward pressure on the US dollar. The sentiment was reflected as well on the Friday session, with the US dollar index dropping 1.83%, which is its largest one-day drop since November 2022. And as well, we also see the US Swiss fall to its lowest price level since 2011. I guess now is the Swiss kind of seen as a safe haven area, while there's uncertainty with the US dollar.
All right, just also on that, on the CPI numbers there, Ollie, one of the things the Fed has been quite vocal of over the last few years is that their preferred measure of CPI is the PCE number, which is actually in the GDP number. So when the GDP data is released, there's about 30 or 40 pages worth of GDP figures that go with it. And it's the PCE inflation number that they quite like to look at. So that'll be the next one. I think markets these days are kind of looking at CPI and even PPI in the States to be more forward indicators for that number rather than outright numbers themselves. But we shall see what we shall see. All right.
When are we expecting that data figure to come out?
US, not that far forward in the calendar. It's certainly it'll be due in the next week, I think, after Easter.
All right, interesting. Yes, we don't have too much forecast. And does that usually trail the CPI? Or does that kind of act as an indicator for the future CPI?
Yeah, the CPI is a pretty good indicator for how the PCE will go. So if the numbers on the headline CPI are good, that's generally going to filter through into the PCE deflator number as well. All right, excellent. Good wrap up on last week. Let's talk about what we're looking at this week. So the big market moves, and before I even start about this, the biggest thing that's going to happen in markets this week and for the next couple of weeks is going to be any headlines on tariffs. So it's nice to have big economic data and events that are occurring, but any news on tariffs are pretty much going to kibosh anything that anyone's got ongoing with their calendars. So do keep an eye out on the news. The Drudge report is normally pretty good. CNN, just keep the headlines up and see what's going on. It's one of the first things I do in the morning is to see what Mr. Trump said overnight on tariffs, because he has gone backwards and forwards and flip-flopped with those plenty. But in terms of economic data or events this week, on Wednesday, we've got the CPI coming out of the UK. That's expected to ease slightly, the year-on-year number from 2.8 to 2.7. The UK has been very, very proactive with what they're doing with their interest rates. They've been cutting rates pretty aggressively this year and into late last year as well. I was saying in one of our meetings today that I actually think that the UK economy will be one of the biggest benefactors of the other end of this. So we're seeing all of the easing of rates. When the economic activity really does start to pick up, I think they're going to be coming from a really nice low base rate, which means I think the UK economy will do quite well over the next 3 to 5 years. On Wednesday, we've also got Canada announcing on their overnight rates. They've done pretty much 50 and 25 basis point cuts every month for the last 6 months. They're expected to pause. So that'll be an interesting one. It'll be interesting to see how many people that trade the loonie are sitting there just on autopilot expecting a cut. But there'll be the market's expecting no real move there. So what that should do is that should help to support the Canadian dollar, and in markets we call that the loonie, because on the one Canadian dollar note is the loonie bird, which is the national bird of Canada. On Friday, we've got Aussie unemployment numbers. We've got a little bit of backwards and forwards in the office around that. I think that's going to be quite strong, as in strong employment. I think, Ollie, you had the other side on that one.
Yeah, well, actually, I did see a piece from the Australian Bureau of Statistics spokesperson. His name is Bjorn Jarvis, essentially suggesting that there is a forecast predicting the Aussie employment rate to go up, but that's more of a result of fewer older Australians in the workforce rather than a weaker economy. Personally, I can kind of see some validity to that. I'd be surprised if it was a weaker economy. I'm not really seeing like unemployment go up as a result of weakness in the Australian dollar necessarily, or in any of the markets. But I guess the retirement age may be coming down, more people getting out of the market sooner. Who knows? Who knows really where that will go?
Oh, that's still a pipe dream, Ollie.
Fair while off for me. I'm not even thinking about it now.
Excuse me. On Friday, we've also got the ECB interest rate decision. They are expected to cut their interest rates 25 basis points. That's pretty much widely expected by the markets. I think that is so widely expected that even the cut on that won't have much of an impact on the euro. Honestly, I think people are more worried in currency markets at the moment about what's going on with tariffs than anything else. But I suspect euro and sterling, despite the recent rate cuts there, I think they're going to be really quite strong currencies over the course of this week. Alrighty, that's this week. And remember, tariffs. Don't forget the word tariffs. On the technicals, do you want to take it away with dollar Swiss there, Ollie?
Yeah, of course. So the chart we got here, so it's the US dollar against the Swiss, the 1-day chart. So essentially what we're looking at on here is a range-bound market, pretty much extending back from mid-2023. It's kind of been hitting the resistance point up around the 0.92 mark, with the lower levels sitting about just shy of the 0.84 level. Essentially, that was pretty much holding strong for at least a few years there until last Thursday, where it fully just broke down the bottom level. Pretty much shoot back down. I think it's around 0.81 sort of area. And then, if we just flick over onto the next slide there, we'll be looking at the 4-hour chart for the US dollar, Swiss franc. So we can see it was kind of trending down. This is since the start of April, trending down, hitting the lower resistance mark below the moving average. It's kind of swinging back up, kind of hitting the moving average in the middle there, keeps swinging down, back down to the lower range, up again. So now it's sitting on the lower band down there. So I'm kind of expecting it to swing back up, kind of hit up towards the moving average, and it might even push back up towards that initial break on the resistance spot. I think that's the 0.82 on the daily chart. But yeah, what do you reckon, Jeff? Do you reckon it's going to keep swinging down, or do you reckon it's going to push back?
Oh, I think after a move of this sort of volatility, some sort of backing up is probably to be expected. If I can just switch back to the other chart, I would expect it to come back up to the base of this this prior support. I think we'll probably see a little bit of sideways action first, and then a move up towards maybe not to touch, but certainly towards that kind of 84-ish level. I mean, for me, what I'd like to do, and I mean that 84 level now is a little bit above those prior lows before there from September. I'd probably want to be looking to sell rallies on this one. It's the one that we used to say is wait for it to bounce up a bit because it is a bit cheap at the moment. Sell a rally with that kind of 0.8425-ish kind of for stops. Dollar Swiss is a funny one because it tends to spend 95% of its time in sideways channels, but when it moves, it really moves hard.
I think that's just off the back of the tariff announcement, wasn't it? It's pretty much just the uncertainty around like the tariff pausing, and everyone might be looking to shift away from the US dollar, maybe selling a bit more in the US dollar, going towards the safer sort of currencies. Guess that's probably what's happened there, but
well, even kind of historically though, I mean, it just does tend to sit in these really big wide bands and then just break out hard. Because I mean, and just to reflect back on this, is that the Swiss franc is a safe haven, but the dollar is also a safe haven generally in its own way. So the dollar is a safe haven because it's the most liquid and the most widely held currency. But whereas the Swiss is a safe haven generally because it stays out of global wars and stuff. That's really why the Swiss franc is kind of a legacy safe haven more than anything else. And the other major safe haven in the currency market is the yen. So the yen is literally just a safe haven because it's kind of contrary to the other economies. The Japanese economy is. To the others, it tends to work counter-cyclical to it, and it's also a big free-floating currency. So there's more yen than euro, which is why the yen is seen as a safe haven. But yeah, for me, I want to be selling rallies on this one. I think there's more to go.
Yeah, I think I'll be agreeing with you on that one.
All right, cool. That's text done. Let's run through some questions. So the way that we normally run this is that the private client group generally gets asked some really good questions from guys that they're speaking to over the course of the week. And some of those questions we like to extend to a wider audience just because, a good question. So we've got two questions today. I'll take the first one there, Ollie. How can I manage my exposure to major events? Oh, there's two different answers to that. Or there's three different answers to that. Firstly, when stuff is impending, I mean, a lot of people will tell you not to trade ahead of payrolls data, right? For instance, right, out of the States, don't trade payrolls data. I think that if you're trading currencies, you're looking for volatility. So I would never cut a position because a piece of data was coming up, and I probably wouldn't, for my own personal trading, I probably wouldn't not put a trade on because data was coming up as well. This kind of volatility that we've got now with the tariffs is a little bit hard to expect because it just happens whenever Donald Trump decides to tweet something. I guess there's two, other than just simply ignoring the major events and continuing and carrying on. There's two different ways to manage this. Either you can really tighten up your stops so that you're reducing your risk on the bad trades, or else if you're still convicted with your positions, I mean, for me, I generally run quite wide stops. I'd be probably looking to widen stops just so that you're not whipped out on one of these short-term, reactionary moves. But again, I mean, you look at that range on the Swiss is like 500 points. So, I mean, you want to have pretty wide stops. So maybe, if you want to manage it, reduce your position size is probably the right answer, and then place stops at logical places.
I think there's a bit of validity into that one as well. Like not trading too many, I'd say having too many different trades on different markets exposed to the same market as well.
Yeah, well, there's that. I mean, we don't really talk about diversification in trading because you're not really holding positions like in an investment. But one of my trading rules is that I won't have more than two currency positions on at any one time, and if I do have two, only one of them can have the US dollar in it. So I don't. If I'm long euro and short the yen, I'm pretty much just short dollar. So, for me, I'm just a bit more careful about what I trade into when I've got existing positions on. What about trade? What about trade wars?
All right. Well, so yeah, I guess question 2 on there is like, can anyone benefit from the trade war? Simple answer, yep. There's definitely the chance for some winners to come out from all of it. We kind of touched on, the safe haven currencies, so say the Swiss franc or the Japanese yen. typically investors will turn to these currencies during a bit of economic uncertainty, so it could see some strength on those currencies. I did actually see an interesting piece on LinkedIn as well by Clifford Bennett, essentially suggesting how China can rise to the top off the back of the trade war. He's highlighted how China's potential growth through diversification may take advantage while the US goes into a period of isolation. It's definitely an interesting thought. Personally, I don't quite agree on it. I think it will definitely lose some of its stronghold on the global economy, but I don't see any one national currency taking over the USD. Maybe once we have a better idea of what's coming out of the BRICS sort of body, we might see it, but for the moment, not too much. But what do you reckon, Jeff? Do you reckon any validity in that one? China can come out on top from the trade war?
I mean, it's hard. I think Russia is going to be the big winner out of this. I mean, Trump's put tariffs on, taken them off, but left them on China. Russia's in a position where they're fighting a war in the Ukraine and they're not really allowed to export very much oil at the moment. I think Russia is the largest store of oil in the world. It's more than the Middle East. So I think Russia's actually going to be the one that benefits from it.
It
But
seems negotiations between Trump and Putin, negotiations between them, they've been going on a bit better than, or at least from what we hear, the negotiations have gone a bit better than previous administrations with the US. So there's no reason why they couldn't come out pretty well from it.
well, I think it was telling that the first international leader that he spoke to after he got inaugurated was Putin.
Interesting. Yes, seems got some unfinished business there, maybe.
Oh, I think they're friends. All right. Well, that wraps us up for today. Just for you guys that are listening to this now, when this is finished, this will be uploaded to the private client room within our client portal. It'll also be updated to our YouTube channel. We also have our weekly technical update that's updated to both of those as well. And just a little bit of housekeeping. There's not going to be any Monday Open next week because it is Easter Monday and I'm going to be in a chocolate coma. And the ASIC part of our business will be off the desks Friday and Monday of next week for the Easter break. So enjoy Easter, and we shall speak to you a little while later. See you, Ollie.
Cheers, Jeff.